September 15th, 2008. Lehman Brothers filed for bankruptcy. $639 billion in assets. The largest bankruptcy filing in history. Larger than Enron, larger than anything before it. A 158-year-old investment bank, gone in a weekend. The collapse of Lehman didn't just end Lehman. It froze the global financial system. It turned a crisis into a catastrophe. And the accounts had been telling a story that wasn't true. Lehman Brothers had loaded itself with real estate assets, particularly subprime mortgages and the securities built on top of them. As the US housing market turned, those assets began to lose value. Like the banks we've covered before, Lehman was operating at extreme leverage. By 2007, its leverage ratio was above 30-1. This is red flag 3. Debt vastly exceeding equity, leaving almost no cushion for losses. But the leverage ratio that Lehman reported to the market was being actively managed to look better than it was. The technique had a name inside Lehman: Repo 105. A repo, repurchase agreement, is a normal financial transaction. You sell an asset and agree to buy it back shortly afterwards. It's effectively a short-term loan using the asset as collateral. Normally, a repo stays on your balance sheet because everyone understands you're going to buy the asset back. It's a loan, not a sale. Lehman structured certain repos so that, under an accounting technicality, they could be treated as true sales rather than loans. By classifying them this way, Lehman could temporarily remove assets from its balance sheet right before the end of a reporting quarter. Then, days later, after the quarter closed and the figures were reported, it would buy them back. The effect: at exactly the moment the market was looking at Lehman's balance sheet, the leverage appeared lower than it actually was. Around $50 billion of assets were being moved off the balance sheet at quarter end using this technique. This is red flag 7 from our free guide. Link in the description. Off-balance sheet manipulation that conceals the true financial position. The accounts shown to the market were, in a meaningful sense, not real. The auditor, Ernst Young, was aware of the Repo 105 practice. A later examiner's report found that the treatment was used specifically to manage the public leverage numbers and questioned whether the auditors had acted appropriately. When confidence evaporated in September 2008, it evaporated fast. Lehman's counterparties stopped trading with it. Its funding dried up. Unlike Bear Stearns 6 months earlier, there was no rescue. The US government let Lehman fail. The consequences were global. Credit markets froze. The crisis that had been building since 2007 became the worst financial collapse since the Great Depression. Leverage above 30-1 with no cushion. Red flag 3. Repo 105. Assets hidden off the balance sheet at quarter end. Red flag 7. Asset values, subprime securities, that were deteriorating faster than the accounts admitted. Red flag 2. The guide is in the description. Free download. Lehman Brothers, founded 1850. The balance sheet was a snapshot. The snapshot was staged. Anyway,